Welcome to the Global Investor Podcast, a show that focuses on helping foreign investors enter the lucrative U.S. real estate market. Host Charles Carillo combines decades of real estate investing experience with a professional background in international banking to interview experts in all areas of U.S. real estate investing. Now, here's your host, Charles Carillo.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com. Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Bernard Pierson. He has over 10 years of real estate investing experience and has recently adjusted his focus primarily to multifamily apartment complexes. Bernard has been a general partner in over 20 properties and invested into over 2,000 units. Previously, he specialized in ground-up development and led the development of over 100,000 square feet of condominium buildings and single-family home communities. So thank you so much for coming on, Bernard.
Thanks, Charles.
So give us, it's great to have you. Give us a little background, both personally and professionally, prior to making a leap into real estate investing.
Great, cool. Yeah. So I was born in Miami, and it's very interesting why my parents were living here at the time, and where I live now, which is Miami. My parents were living in Miami when I was born. We're from Nicaragua, originally Central America, and there was a war going on, right? So my parents were living here during that time because of the war and because of different reasons, right? And just I was just born here during that time. When I was around about 6 years old, my family moved back to Nicaragua, so I did grow up down there. So my background is from Nicaragua. I went to high school there and everything. So I'm Nicaraguan American, I consider myself. And I started off my real estate journey in development, mostly in the development world. At least the active side of things were in the development world. And this was in Nicaragua and Costa Rica, and we would build condominiums and single family homes. And eventually, about 5 or 6 years ago, I transitioned into full-time value add multifamily. I also did some academic stuff on the real estate side. I got a master's at Georgetown in real estate about 4 or 5 years ago, and I did a certificate at MIT. So I've been very interested in the whole real estate thing for quite a while, and I love it.
Other than being in the construction portion of it and then going into more the investment portion of it, why did you choose real estate as your investment vehicle?
So great question. So before real estate, I used to be in food brokering, and I've always been an entrepreneur. I only had a W-2 1 year out of my life, that first year right out of college, and after that I just went straight into entrepreneurship. And in that gap, right before I went from that W-2 to eventually real estate, at a time I was doing food brokering, and we were successful. We made good money. What I figured out pretty quickly was it was a very transactional business, and technology was pushing us out very quickly as well, right? Because of just the whole globalization thing, and now we talk about deglobalization, but regardless, back then it was very easy for the supplier, I guess, to find and start working directly with the buyer, with the end buyer, and we were becoming very transactional, and I could see that eventually we would be pushed out, and we had made good money. So I was looking for options on where to invest the money and create strong or streams of income, or dependable streams of income, and that's how I landed in real estate. Must have been in 2012-ish, 2012, 2013, more or less.
Yeah, that's a great story, because I think a lot of people, before getting into the investment portion of real estate and actually taking money from investors, stuff like this, I was using it as a way of making my income that was semi-transactional at that point more of a investment passive, kind of growing, not correlated with your, your regular job, your regular company. So that's great. So tell us about like when you got started into multifamily, as you were just saying, how did you get started? Were you passively investing? Were you, did you buy a property by yourself and you, third-party management with it?
Yeah. So, several answers. So my first ever multifamily deal was, I want to say it was 2011 or 2012. I'm not 100% sure. And I'm not sure if it was either. So I did two things at the same time. I invested as an LP in a deal with with another sponsor, and I bought a duplex down here in Miami. So I'm not, honestly, I don't know which one came first. I don't remember. It was just such a long time ago. I don't remember. But after a while, I started seeing my duplex was doing great, right? Or well. Honestly, it kind of just appreciate it. It was third-party property managed. I didn't want to deal. I knew that they wanted that I didn't want to do the property management business myself. Things have changed a little since, but back then I knew I just didn't want to be in the day-to-day with the tenants. And I hired property management for that duplex. And regarding the LP position, I started seeing how it went very well. The sponsor delivered. The cash flow was coming in as promised, or at least as presented. And eventually it went full cycle, and I did a bunch of LP deals, and that path kind of took me into into being more curious, I guess, about the GP side or the active side of things.
Interesting. Before we get more into your business, I just have a question because you had made the transfer into multifamily investing. And this is an asset class we talk a lot about on the show is multifamily. And what were some of the pros of why you chose multifamily? Because there's so many different asset classes that one can invest into.
Right. So back then as an LP, I most of my investing was multifamily, but here I did do some investments in office. I did do some investments in mobile home parks. I did do some investments in I think I mentioned office already, but office, retail. So I did test out the different self-storage, right? They all did well. Multifamily for some reason was doing better back then. I didn't really understand it back then, why it was doing better than the rest. But it was just more consistent, and that kind of led me to follow that path. With that said, we've had great years in multifamily for the last, I want to say, 8 years or even more. I mean, depending on how you look at it. So I've always liked the fact that multifamily, you provide housing, right? So it's an important service that you're providing. It's a great service to your tenants, to your residents, and and on the investment side, it's a need, right? Everyone needs a housing. Everyone needs a place to live. So for me, that was just kind of like the easier decision to just choose that asset class.
Interesting. So, Bernard, mainly you're working when we know each other from a mastermind group, and you're primarily working with international investors, mainly Latin American investors, obviously, because you relate to them very well. What differences do you really see, let's say, between U.S. investors and Latin American investors, in all senses of properties they're looking for, risk tolerance and returns they're looking for, et cetera?
Yeah, so I do identify very well with them because I used to be in when I did my development work, it was in Latin America, right? Which was a couple of years ago, or about around the same time I did those LP positions. I was also developing in Latin America, so I know the pain of doing business in Latin America. With that said, there are opportunities, there are good things about it, there are great things. But it's not for everyone, right? So there's a lot of pain involved with doing business in another country. And things as simple as property rights are not as easily, they're just not easy to work around as they are here in the US. The legal system is different. It's a different legal system. The expenses, believe it or not, can be higher. So things like materials are probably going to be higher in Latin America than in the US. Labor, probably cheaper, right? But the materials are going to be more expensive. Credit is very limited in Latin America. We don't, especially so when you look at residential, part of the reason there's in a way, I mean, probably right now is not the perfect example with SVB and everything, right? But there's an abundance of credit, right? Because we have Fannie and we have Freddie, with on the multifamily side. We don't have that in Latin America in most countries, at least not a big institution that can do this. So there's limited liquidity, there's limited equity. After a while, I analyzed the whole thing, and just the risk return profile in general was inferior, in my opinion, in Latin America, and I studied this deeply. With that said, going back to your question, what they look for. So I identify very well with them because of those reasons, right? And I've been through their pain. I've been through that, and culturally I understand them. And what they want is we've gone through a lot of trouble in most countries in Latin America. Most countries have gone through wars. We've had hyperinflation. We've had limited credit. We've had numerous things, right, that have complicated life to a certain degree for us down there in general. Every country is different, right? But in general, so they just want to know that they're not going to lose their money. That everyone has lost, especially if they're high net worth. They've had bad experiences at one point in their life, and they just want that security, right? And they just want to know that they're not going to lose money. Now, the appetite, the risk appetite is pretty high because it is a pretty risky environment in general. So we're used to it in Latin America to have high risk. Now we do expect high reward with the high risk. With that said, right now, recently, where we're seeing in the U.S. probably it's not as easy. Investors are a little bit more cautious than they were probably a year ago today, right? In the U.S. and Latin America, there is some of that, but in general, they're not. Their mindset is still pretty bullish, right? Because we're used to having recessions constantly. We're used to having inflation. We're used to this is not scary for us, right? We've lived this numerous times. So my feeling has been with investors in Latin America right now, and in Latin America in general right now, is that they're still investing and they're still pretty bullish, right? Or pretty, I guess, bullish and aggressive in their needs and investments.
Okay. Yeah, that was one of my questions coming up was that with interest rates rising or have rise to the top wherever we are now, and inflation is still a concern, even if it's not growing as much as before. I mean, they're still very much interested in investing into the U.S. market, and there's still an appetite for investing into U.S. apartments.
Right. Yeah. I'll give you an example. Like some of my investors, just the fact that they invested in the U.S. and converted their currency into dollars, saved them from 100% hyperinflation like they saw in Argentina, right, last year. Right. So just that was enough of a win. Right. They didn't even need that 20 or 15 or 20 or whatever IRR you achieve for them. They didn't even need that, or the cash on cash. And the interest rate, the interesting thing about interest rates is, we in the US right now, we're like, oh wow, interest rates have shot up drastically right in the last year or so. When we compare that to most of Latin America, it's a lot cheaper. Money down there is expensive usually. When you go to a lender, it's going to be a lot higher than it is here. Yeah. So, it doesn't. They're not going to see it as, oh wow, that's a high interest rate. That's not going to be their reaction to 5 or 6% interest rates, right?
So with one of the questions here is that obviously different countries, I know like Argentina is one of them, and I've spoken to investors there. It's difficult to get money out. It's difficult to get money out of their currency. I mean, what are some of the challenges that you have found with some of your Latin American investors investing into the U.S.? We've kind of gone through the mindset. They're very bullish on it, but going just the mechanics of what needs to be in place or what issues that they might have, currency conversion may be one of them.
Currency conversion, definitely, depending on the country. There are other countries that limit the amount of money you can take out, or they tax you if you wire money outside of the country. So that is one. Countries like Argentina are going to have that. Venezuela has had that for years, and there are numerous countries, right, that you have to understand that a little. The other part is always going to be, well, first of all, you have to know who you're dealing with. You have to know who's investing with you. You want to make sure that this is clean money, right? To put it bluntly. And usually what happens is, so you go to an investor down in, let's say, Argentina, right? And he says, okay, I'll invest $50,000 or 100 or 200, whatever that number is. Before you know it, you end up seeing that he needs to talk to an attorney or a CPA. When he goes to that attorney or CPA, the first thing they tell him is, you know what, you should probably form an entity or structure this a little differently than just investing. And that takes time, right? So if anyone is looking to raise money from overseas or Latin America specifically, I would encourage them to get ahead of that with their investors and have them structure themselves. Some of them are going to invest personally, but a lot of them aren't. Especially if they're going to invest a substantial amount over a period of time. There's a lot of reasons why they wouldn't want to invest personally if you're from Latin America. There's only 2 countries in Latin America that have a tax treaty with the U.S. Right? That's going to be Mexico and Venezuela. Venezuela is basically out because of reasons that for many of us are obvious, right? So they're probably not going to be your target to invest in. Most of the Venezuelans that will invest with you are probably in the U.S. already or have a U.S. structure with that they can use to invest. So for you, they're going to be a U.S. person, right? So you don't really have to worry about the Venezuelan. So that tax treaty is really not really beneficial for us. The Mexico tax treaty can be beneficial, but no one else has a tax treaty. So that it doesn't complicate things, but it makes it such that the investor has to be more mindful of how they structure themselves to make it efficient, right? And there's also a bunch of other things, asset protection, like if there's tax laws, like if you pass away, and like us in the U.S. I mean, I'm not a CPA or anything, but I'm not trying to give any tax advice here, but like if we were to pass away, I think we can leave I want to say $10 million without paying taxes to 12. Okay, 12. For foreigners, that number goes down to, I want to say, somewhere between 50 and 100. They've changed it.
60,000 last time I checked.
60. Okay.
But all this stuff, check with you. None of us are attorneys or CPAs.
Exactly.
But it goes to show you $12 million on the 60,000. It's a huge difference because you can make $60,000 on 50,000. You know what I mean?
Exactly. So potentially this investor from Latin America somewhere, right, is investing 200,000. Well, now he has a big problem. Yeah. If he were to pass away, right? So he has to structure himself. There are ways to structure that so you can avoid that potentially, right? From what I've been told, right? But do your research and talk to professionals about this.
When you're, let's say, structuring deals and offerings to investors with let's say the target or the majority of the target of these investors will be Latin American investors, do you modify these at all to make it more appealing to your Latin America or international investor base? Whereas I know, because when we've done it before, we have a lot of investors that have chosen that are non-US to invest in something that's really like a preferred equity model almost. You know what I mean? Where you're getting a set percentage, no upside, but you're getting a set percentage, whether it's 8, 9, 10, 11, whatever it is on the deal percentage, paid monthly, and they choose that over something where most American investors are going to look for upside and they want to get, they want something like the high, teens or something.
Right. Yeah. So we don't do that, but I know where that's coming from, because there is a mentality that cash flow is very important, right? Like for them, right, it feels like, okay, so I invest today and I'm getting money back and it's a fixed amount. I don't have to worry about what's changing. I don't have to, culturally, we tend to be very skeptical because we've gone through rough experiences, right? So it's better if you just tell me that's the mindset down there, right? Just tell me the rules up front. I just want to know how much I'm going to make. I don't care. So don't give me the variables. Tell me how much I'm going to make, and that's where I see the preferred equity, or just a fixed amount of preferred return being a good model. We haven't done that. We just offer the regular LP position. With that said, there is another reason why the preferred equity or the fixed return model can be beneficial. And again, want to make clear I'm not a tax professional, but look into it. There are laws that can help you minimize significantly, and sometimes to zero, the withholding to foreigners if you structure it as debt, right?
Oh, interesting. I wasn't even thinking that way. That's great.
Yeah.
So,
So I
Bernard,
do know that,
yeah.
that some of my investors, that's what they do. They create an entity, right? And they structure it so that that entity is a U.S. entity, and they structure it in a way where they get a fixed return, right? They almost lend money. I mean, I don't know the details, but yeah, it's common to use.
Yeah.
Portfolio
It's just,
loan exemption, I think it's called. So if you're interested in looking into it,
what was it? Say one more time.
portfolio loan exemption.
Okay. All right, definitely.
Yeah.
Because usually with someone that's international reaches out to us to invest, it's something where first thing we do is we put them in, give them a list of attorneys and CPAs that, mainly that obviously if they're foreign, they speak their language or that very knowledgeable of their culture.
Yeah, they're familiar with laws and
then they can
we
figure
do
it
the
out.
exact same thing.
Yeah.
We do the exact same thing. We have our we know attorneys and CPAs that we refer our investors to. We don't give them any tax advice because we're not qualified for it. But we refer them in the direction that where they may help them. Yeah.
Also, it's going to be completely different. Someone wants to invest $50,000 versus $5 million or $500,000. It's completely different setup, and over how many years in the whole 9 yards.
100%. Yeah.
Bernard, so tell us, how would you suggest a real estate investor to prepare for a downturn? If we have a pullback coming that's more than what we've already seen, how do you prepare your own portfolio, and how would you suggest another investor to prepare for?
So there's several things, but in summary, I would, if you're looking at new acquisitions or even your current holdings, be conservative with your underwriting. Don't be aggressive. It's not the time to be aggressive. It's not the time to consider huge rent growth or anything like that. If you're acquiring or refinancing or something, we're in an environment where I would like to get longer term debt. It doesn't necessarily have to be a 10-year term, right? But at least 5, maybe. It's also not a time to do heavy rehabs.
Yeah.
I would say for a property. So if, on the properties we own right now, we're not investing significantly into the cosmetic look of the property. And there's 2 reasons. Frankly, we're not seeing it pay off as much as it would maybe a year or 2 or 3 ago, and we prefer to have that cash ready in case we need it. Right? We think that's a better way of avoiding capital calls and all this type of issues that can arise in this environment.
Yeah. No, it's great. It's the same thing as we had one property we were doing prior to everything kind of happening, 18 months ago, let's say it started. We were doing like 5 turns on one property, full upgrades into them, the whole 9 yards. And now when we're doing turns, we're probably doing 1 upgrade per unit per month. You know what I mean? And just kind of testing the appetite, keeping the plan going. You know what I mean? But it's just really testing that appetite. Are we getting the rents that we thought? Is it still make return? Because most of the time, like you said, it's a lot of painting, cleaning out the door, with a little bit higher rent, but nothing crazy.
Exactly. Yeah. That's what we've seen across our properties, that we don't have to go all out right now. And we're mostly, for the most part, choosing not to, or as you said, we're choosing to go maybe more slowly. Right.
Yeah. So Bernard, you've been investing or involved with construction projects, investing in your own properties, investing third parties. What are common mistakes that you've seen over your real estate investing career that real estate investors make?
Optimism is number one. I think most real estate investors and entrepreneurs we tend to be optimists, and sometimes we overlook things that can happen, or maybe we think we can pull something off in a year. And when it really takes 3, right? And I see that's probably the most common mistake I've seen. Sometimes I've seen over leverage. Maybe there's no need always to max out your leverage. Aggressive assumptions, definitely, but that's maybe related to optimism, where rent growths are too aggressive on per underwriting. I've also seen the operators looking at deals and reducing expenses too aggressively, and it's not easy to reduce expenses in a property unless you have an edge and exactly how you're going to do it. If you have an edge and you have the experience, and hopefully even the experience in that specific market, you may understand how you can reduce expenses. If it's a new market and you're new to multifamily, it's very easy to think you're going to reduce expenses, and then when you get in, you realize that's not the case.
Maybe off the beginning, you change some vendors, you save some money there, you change your property management, you change money there, but consistently showing expense reductions is just not really, you got to really focus on the income is what I found.
There are cases where expenses are obviously too high. I mean, maybe water is too high and, there's a leak or something. So there are cases where expense reduction is definitely part of the plan, but I do see it as a common mistake where investors tend to be very aggressive with what they think they can achieve with, or with those expenses they think they can operate the property.
Oh, that's great. Yeah, some great points there. So Bernard, you grew up partially in Latin America and then here in Miami, in the United States. I mean, how has your relationship towards money changed over the years, having so many different perspectives from living here in the US and then also working, predominantly with people in Latin America? You hear all these different ideas and thoughts of where everything's going.
So I've and me, my family, my be it my cousins, my uncles, my parents, and my immediate family too. We've made money, we've lost money, we've been up, we've had ups and highs throughout our life, and that over the last 10 years, I guess that's part of the reason why I'm more focused in the U.S. now, where things are more stable. But so to answer your question, today I don't see the money as mine. Or as my family, that's something we're borrowed. We're here to use it while we're here in this world, and we borrowed it to just make the best impact we can on society, and if that means growing it to buy more properties and improve more properties, well, that's that, right? If that means doing eventually philanthropy, well, then it's that, right? There going to be numerous ways to use it, but to answer your question, I try to see not the money as mine and not get to create too much of a, I guess, intimate relationship, if you will, with money.
Interesting. That's a great response. So what do you think are the main factors that have contributed to your success over the years?
Perseverance is definitely one. You have to keep on going. You're gonna mess up. You're gonna be you're gonna want to quit, right? If it's a strong word, I know quit is a strong word in our world, especially. But you have to persevere. You have to be confident that you'll make it. Some of us got lucky on the first deal, right? And perseverance is not that important, but some of us don't. Sometimes it takes 5, 6, 7, 8, 10 deals. And the other thing that really has contributed to my success is making mistakes. They can tell you all day about the mistakes. I can tell someone about a mistake all day and avoid certain mistake. But the reality is, what I've seen with me is until I make that mistake myself, it's not going to have the same impact.
Yeah, the other thing too is getting success too early. I see, you know what I mean? Because then you're used to it. And then you're like, and then if you're not preparing your investors, every time I get on call with investors and they're looking at a track record, you're like, this probably won't be what's going to be for the next, this the last 5 years won't be for the next 5. You know what I mean? Just letting you know.
We're in a tough spot, right? Because we've had very good years, right? So.
Yeah. Bernard, so how can our listeners learn more about you and your business?
Just go to my website, equitypartners.com. So equity is with an I at the end for international. So EQUITI partners.com.
Okay. Well, thank you so much for coming on today, Bernard, and looking forward to connecting with you here in the near future.
Great. Thanks, Charles.
Talk to you soon. Bye-bye.
Thank you.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Thank you for listening to the Global Investor Podcast. If you like the show, be sure to subscribe on iTunes or Google Play to get new weekly episodes. For more resources and to receive our newsletter, please visit globalinvestorpodcast.com. And don't forget to join us next week for another episode.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars LLC exclusively.